If you're scrambling to figure out your tax bill situation here at the end of the year, if you haven't made any estimated taxes, if you don't know what estimated taxes are, if you don't know how much you should be paying in estimated taxes, this episode is for you. Hey, it's Stephen Young, the host of the Savvy or Surrender podcast, and I am coming to you today to talk about your favorite subject, taxes. But I have found a lot of questions about estimated taxes, who should pay them, when they should be paid, why are they being paid, and so we're going to address all of that in today's episode, covering estimated taxes so that all of your questions are answered. You know exactly what you should be doing. And before we get started, if you could do me a favor, if you're watching this on YouTube, click that subscribe button, the like button. I would greatly appreciate it. Really help our channel to be able to reach out to more business owners so that they can be successful and set up for success with taxes especially. We don't want you to surrender. We want you to be a savvy business owner. And if you're checking out the podcast on Apple Podcast or Spotify or any other place, savvyorsurrender.com, whatever it is, if you could leave a review, especially if it's a 5-star review, would greatly appreciate that. And if you have any questions, anything you want to address on the podcast, you can always go to savvyorsurrender.com, check that out, or you can go to podcast@savvytaxstrategies.com and leave us an email. Okay, so how do we figure out taxes exactly? What are estimated taxes? Well, quarterly estimated taxes are for business owners, especially contractors, but all business owners they're typically cash-based, meaning taxes aren't withheld automatically. Well, the IRS, believe it or not, they like to get paid at least every quarter. They want that money coming in on a regular basis. They don't want you to hold all that money through the year and then pay them on April 15th or whatever your tax deadline is, or you extend and you're not paying for 2024 until October 15th of 2025. The IRS doesn't like that. They want their money as quickly as possible. So estimated taxes are necessary. Okay, so what do they cover? Estimated taxes, when you pay it to the IRS, covers your federal income tax, that withholding tax. If you were employed, that would be like box 2 of your W-2, right? Box 1 has your total income. Box 2 has your federal income tax withheld. And then it also holds your self-employment tax, especially for sole proprietors, LLC. You've got that 15.3% tax that covers your Social Security and Medicare. So those estimated taxes is going to include that. So automatically, you need to be paying over 15% of your profit just from the self-employment tax. And then you also need, if you live in a state that has a state income tax, you need to be doing estimated tax payments for the state income tax. That's going to be a separate payment. Now, you can make all of these online, or your tax professional can give you vouchers that you can write a check for and send it in. Whatever works for you. It's really easy to do online. That's my preferred method, but whatever works for you. And don't forget about the state income tax. I have a lot of clients who would have done the IRS, but they forget about the state, and now they owe thousands of dollars to the state. So don't forget about that one. In Idaho, for example, it's 6%. California, estimated tax payments are ridiculous. I know, but hey, you get to live in California. It's beautiful. You're by the beach, right? All right. So who needs to pay quarterly taxes? You're required to pay if you expect to owe $1,000 or more in taxes when you file, and if your withholding is not going to cover it. So if you expect to pay $1,000 or more in taxes, and if your withholding won't cover it. Now let's break this one down. So contractors almost always meet this threshold. Pretty much any business owner that's doing well is going to meet the threshold of over $1,000 in taxes. It doesn't really take very much, right, to owe $1,000 in taxes. So the biggest mistake that I see is that business owners will get busy, right? They'll have that busy season and all that profit, and they'll start making up all their bills that they weren't covering, and they'll use that profit to cover their bills, and they'll forget about moving it to their tax account and paying their taxes, which is why and then you don't necessarily know, how much was actually profit. My financials are a mess, and you don't know how much you should be setting aside. So let's take a look at that. There's something called the IRS Safe Harbor Rule. And I look at this as really kind of your best friend for when it comes to figuring out estimated taxes. In order to avoid penalties and interest on estimated taxes, you are supposed to pay at least 90% of this year's tax or 100% of last year's tax if your income's less than $150,000. If it's more than $150,000, you pay 110%. So let's look at this. If you make, let's say you are going to make $100,000, and we're just going to say that you need to pay 30% in taxes, 15% for the self-employment tax for Social Security and Medicare, and 15% for withholding. So $30,000 for the whole year should be paid in taxes. You should have paid then 90% of that, or $27,000 divided by 4. So whatever that is, close to $7,000, right? Little less than $7,000 every quarter on average. That's where you should have been paying. Now, if you hadn't figured that part out, if you didn't know when those taxes were going to be due or how much you should be paying, your backfall, your safe harbor, is looking at last year's tax return and coming up with the safe harbor rule, which is 100% of last year's tax. So if last year you paid $20,000 in taxes because you weren't doing as well in business, so maybe you only paid $20,000 in taxes last year, then you're going to pay $20,000 divided by 4. So you're going to pay $5,000 per quarter, or 110% if you made more than $150,000. So let's say you made $200,000 to keep the numbers even. And so $200,000 at 30% is a $60,000 tax bill. That $60,000 divided by 4 is $15,000. So you should be paying, or I'm sorry, it's 110% of that. So that's $220,000, and there goes my easy math, right? So you got $220,000 is the income on there, and then you've got your taxes divided by 4. You'll figure it out, right? So it's 110% if your income's over $150,000. So 90% if your first year in business, you have no idea what you are going to owe in taxes. Take your profit 90%. You can do it every quarter. Every quarter, look at your financials. What do you have in profit? You got $50,000 in profit? Perfect. 90% of $50,000 is $4,500. We're going to pay that in taxes. Well, it's $45,000, and then we're going to do 30% of that, and so on. Okay. 100% of last year's taxes if we have last year's taxes. So this is huge because it means that even if you owe way more money, like this year just took off and you doubled in business, all you have to do is match the safe harbor, 100%, 110%. Now, the other way is to just simply to calculate your quarterly payment, and I've already kind of given it to you, but you take your projected profit, times it by 30%, so that's going to be your tax rate, and you just pay that quarterly. And then that's the easy way to do it, right? If you don't know the 90% and the 30% or the 90%, and that's just getting way too confusing, look at your quarterly profit. It's $50,000 this quarter. Cool. Take 30% of that. It's $15,000. That's your payment. $50,000 profit times 30%, $15,000 goes to the IRS. That's all you got to do. Okay? All right. Now here's mistake number 1 is waiting until tax time. I just met with a contractor yesterday who did not make any estimated tax payments in 2023. So when their 24 tax bill came due, they hadn't made any payments. Now, 2025, or they started the business in 23. They didn't make any payments. 24, big tax bill. 24, they doubled, didn't make any estimated tax payments because they were paying off 23. March of 2025, they're meeting with their accountant, and they find out that they owe over $18,000 in taxes and another $5,000 in penalties. And they said, we want to not pay these penalties. How do we get out of paying these penalties and interest? Now, you can get some penalties abated. There is an opportunity there where they call it a first-time penalty abatement, where the IRS will waive those penalties for you. They'll do that every couple of years. They call it a first-time penalty abatement, but every couple of years it kind of resets. But they get to decide if they're going to waive those penalties for you. So you have to either call them, wait on hold on average 45 to 50 minutes or so, and then just ask them. You don't even have to have any papers. You don't have to do anything, no forms. You can just say on the phone, you have to verify who you are. You can say, hey, I'd like to get my penalties abated. They'll tell you right away if it's available. And then they'll say, okay, we're going to send you a letter. You'll get it in 7 to 10 days. It'll show you what your income, your refund is, or whatever, where you refund or how much you owe now, whatever it is. But all those penalties will be abated. The other option is to talk to your tax professional. We do this for our customers when they have these penalties, where we'll get a power of attorney for the IRS, and we'll call them. We have a special number that we can call. We get in faster. We can talk to them about 5 clients at a time and get them taken care of. So that's the other option there. So you can get these penalties abated if you get them, but don't make it a regular basis, because really the issue is now you can only do it once every couple of years, right? So, and that was one of their questions was, can we get these penalties abated? And I said, yes, but if you have other penalties now for this year, you won't be able to get those abated. So you want to choose which penalties you're going to have to deal with. So the way to fix this is to pay a consistent amount each quarter, obviously, right? That's kind of the easiest way. Now, mistake number 2 that I see a lot is not setting money aside every week. And that's where, of course, Profit First comes in. So your Profit First tax account solves this. If you're set up with Profit First, and if you haven't heard of Profit First, got the book right here. Right? Profit First there. You can go to Amazon, pick it up for, I think it's running about $13 right now. I've seen it as low as $8.50, I think, on Black Friday, about as high as $13. And pick it up, over 1.4 million copies sold. Mike McAllowicz is the author of it. Great guy. I've met him a couple of times. And I am a certified Profit First professional, helping business owners to implement Profit First into the system or into their system. I've talked a lot about that. There's a couple different podcast episodes that you can check out to learn more about that. I think specifically episodes 3 and 4, I think you can check out and learn more about Profit First. You can also go to savvytaxstrategies.com/quiz and find out how profitable your business is and get the core chapters of the book for free to be able to implement into your business. Okay, one of the accounts that you set up with Profit First is a tax account where every week you're automatically putting money into that tax account so that every quarter when taxes are due, you have that money there set aside for you. And that's the best way, because then you don't have to worry about it. It's just an automatic payment. Now, the next question is, what about if I'm an S Corp owner? Do I need to pay quarterly payments or quarterly tax payments as a S Corp? And yes, is the easy answer, but it's a little bit different. If you're set up correctly as an S Corp, and I pray that you are. If you're not, I want you to get set up correctly as an S Corp owner. You need to be set up with payroll. If you are an S Corp, you need to have a regular paycheck. Now, when I say a regular paycheck, all I mean is that it's being reported as a W-2, like you're an employee of the business. The business is now its own entity. It has its own tax return now. Whereas when you were an LLC or sole proprietor, it just stayed on your personal taxes. Now as an S Corp, it has its own tax return. It doesn't pay any taxes except for in California, maybe some other states. I know California does. It has a minimum of $800 in taxes. But for federally, for IRS, there's no taxes due. It still flows through to the owner's taxes, to your own 1040. But it does have a return that we have to report, an informational return. So you also need to be on payroll for that. Now, how you set up payroll for your S Corp is up to you. You can have it where every week you get paid, every 2 weeks you get paid, every month you get paid. Or you could have it where you just take a portion of your distributions and you call that payroll. So what do I mean by that? Let's say on a regular basis, you take $2,000 a week out of the business account, put it into your personal account. That's your distribution. That's what you're living on. So for the quarter, say we got 12 weeks, you've taken out $24,000. Well, that would come out to a $96,000 salary. Maybe you don't need to report a reasonable salary of $96,000. Maybe you only need to report a salary of $48,000. So every quarter, we're going to report payroll for you of $12,000. We do that at the end of the quarter. We say, okay, they had a payroll of $12,000. The payroll company that you're using, or the tax pro or your bookkeeper, whoever is doing your payroll for you, will withhold the taxes, the self-employment tax. It may not be called self-employment tax anymore because you're an S Corp, but it's the same thing. It's still 15.3%. You as the employee are paying 7.65%, and your business is paying 7.65%. So at the end of the day, still 15.3%. And then also the federal withholding, state withholding, all of that's taken out of your paycheck, right? Out of your paycheck. It's basically a paper paycheck, but that's going to come out of your account. And then your payroll company is going to send that to the IRS and to the state, whatever entities need to be done. And then at the end of the year, you're going to get a W-2. So you can have your payroll set up however it works best for you. But that's only for the payroll. Now, if your withholding tax doesn't cover your distributions, you still have to pay tax on your distributions. You don't have to pay the Social Security and Medicare anymore, but you do still have to pay that withholding tax. So that other $12,000 that we took out in distributions for the quarter, right? We had $2,000 a week times 12 weeks for that quarter. 12,000 of it we reported as payroll. The other $12,000 in distributions still has to pay tax, still has to pay that federal withholding tax. So for the IRS specifically, you're going to send in a voucher every quarter with, let's say, 15% or whatever your effective tax rate is. You can figure that out. You can ask your tax pro, hey, what was my effective tax rate? But let's go with 15%. So you're going to take that $12,000 times 15%, which is $1,200 plus another $600, so $1,800. We're going to take that $1,800 and we're going to send that to the IRS as a distribution, as an estimated tax on the distributions. And then, of course, state taxes still as well. They want that money. So again, Idaho is like 6%, so we would send that in as well for every quarter. Now, when I say every quarter, the other thing, the next thing I want to make sure that is clear, is when these taxes are due. Because, of course, the IRS can't make it simple for us. Your payroll taxes are due 30 days after the quarter ends, the regular quarter. So quarter one from January 1st to March 31st, that's quarter one. That report for your payroll taxes for all your employees and for you if you're an S Corp owner, that all has to be reported by April 30th. You get 30 days. And your payroll company or whoever will send in the federal 941, your state tax, whatever that form is, 910 or whatever. And so you'll send those in at 30 days later, right? So you got regular quarters, January 1st to March 31st, April 1st to June 30th, July 1st to September 30th, October 1st to December 31st. 30 days after that, those forms are due. That part's simple. What about your estimated tax? Those are completely different. So the first one is due April 15th for quarter one. So from January 1st to March 30th, or March 31st it is, I believe. Let me check here. Yep, March 31st. So those are due April 15th. So you have to pay your estimated taxes for quarter one the same day as your personal tax return is due. Talk about injury to insult, right? So April 15th, you have to make that first one. And that's usually the hardest one for people to make because they're just kind of figuring out, maybe if they didn't extend, they're just kind of figuring out what their estimated tax should be. So you make that first one on April 15th. Now, when is the next one due? You would think it would be due maybe July 15th, right? No, it is due June 15th. June 15th is the next quarter, and it's due for, and it's not even a quarter, it's from April 1st to May 31st. So your next estimated payment is due on June 15th for the period from April 1st to May 31st. So you kind of lose a month there. And then the next one is due on September 15th. And so that's from June 1st to August 31st. June 1st to August 31st, you have to make that payment 2 weeks later on September 15th. And then the last one is due on January 15th. And so that's from October 1st to December 31st. So for that last extra quarter plus a month, you're paying all on January 15th. So that's why you may have a tax bill due here on January 15th. Okay, what if you are behind? We have a couple of options. The first one is catch up gradually using the safe harbor. Figure out what your tax payments were, depending on where you are in the tax cycle. We happen to be recording this. I'm recording this in second week of December. And so we're kind of late in trying to gradually catch up. So then the next option is you just make a larger Q4 payment. that will be okay. You might have a little bit of a penalty, but at least you'll be caught up. So January 15th, make a larger payment to catch up. Again, looking at that safe harbor, 100% of whatever your taxes were last year, 110% if you made more than $150,000, divide that by 4. Those are what your payments should be every quarter. If you didn't make that amount, that $20,000 or $30,000, whatever it was, if you didn't make that payment amount, try to get it caught up as much as possible in quarter 4. Don't just think, and a lot of clients will say this, they'll say, well, I'll just get it caught up when I report next year's taxes. The problem with that is then you should have already made 4 payments, and now you're going to be behind, and they're going to assess those penalties and interest. Now, are those penalties and interest a lot? Not necessarily in the beginning, but they do start to add up, and it can become hundreds of dollars. And then the longer you take to pay, it can become even more than that. And the interest, I believe it just changed to, I think it's 6% per month, capped at 20% or 25% or something like that. I don't remember the exact percentages, but they will let that grow every month. You have to pay that. And so it can get big pretty quickly, especially if we're talking about, if you're doing $500,000, $1 million, $2 million in business, and you're doing really well for yourself, but you're not paying any taxes, it's gonna add up. So file early, settle up as quickly as possible. Don't ignore it. Don't go and throw your head in the sand and become an ostrich and pretend like it doesn't exist, because it is going to stick around. Now, I have had clients come to me and say that, well, I haven't filed in 7 years. I want to get this caught up, but how come the IRS has never talked to me? Well, the reason why is because the IRS only gets income reported to them if you have a W-2 or you have 1099s. If you're a cash-based business or something, you own a retail store, something like that, and there's no reports being sent to the IRS, they don't know that income is coming in. They don't know that you're making any money. You could be living in Europe, you could be living under a bench. They have no idea. So they don't know that a tax return is due. If they're getting W-2s, or if they're getting 1099s, maybe you're a sub and you're working for a general contractor who's sending you 1099s, they're receiving those, they have a file on you and they know that you should be paying taxes. They will do a estimated tax report and send it to you and say, hey, this is how much money you owe. And they don't even give you the benefit then of doing any kind of deductions. The states, I have found, are typically faster at this than the IRS. So don't be surprised if you live in a state that has a state tax. You may get a form from them and a threatening letter from them a lot faster than you do from the IRS. So quarterly taxes don't have to be scary. When you have a formula, you have a plan, you know what to do with them and when to pay them. And again, Profit First eliminates a lot of the fear and anxiety of quarterly taxes. So if you have any questions, if you think, hey, this sounds fantastic, I am so glad, well, maybe it doesn't sound fantastic, but if you're thinking, hey, this is more information than I've ever received from my current professional, I would like to have Savvy work with me, go to meetwithsavvy.com and schedule a free discovery call where we can talk to you about your situation and see if it makes sense for us to work together. With that, I wish you much success this holiday season, many happy holidays, and whatever holiday you happen to celebrate. And I will see you on the next episode.